Off to D.C. we go, and that's where we find Bloomberg News international economics and policy correspondent Michael McKee. Mike.
We've got some news from the minutes today, as there was a lot of discussion apparently at the last meeting about trade, tariffs, banks, and the balance sheet. While officials saw a strong economy with a solid labor market and declining, if still too high, inflation, they spent a lot of time talking about potential policy changes and financial market supervision. A number of participants suggested the recent rise in monthly inflation was likely due to seasonal factors, noting substantial progress before that, but potential changes to trade and immigration policy from the new administration had the, quote, potential to hinder the disinflation process. One concerning note, business contacts in a number of districts indicated that firms would attempt to pass on to consumers higher input costs arising from potential tariffs. Many said companies were reporting substantial optimism about the economic outlook given potential easing of regulations and tax cuts, but some participants reported increased uncertainty regarding potential changes in federal government policies. Altogether, Fed officials generally pointing to upside risks to inflation from tariffs and immigration policies, geopolitical threats, and stronger than expected consumer spending. They worried it might be hard to distinguish persistent changes in inflation from temporary ones caused by policy changes. There was also discussion of financial market vulnerabilities, including banks' reliance on reciprocal deposits, the risk of unrealized losses at banks and non-bank institutions from any potential rise in long-term interest rates, asset valuations, and commercial real estate exposures. Several commented on concerns that primary dealers didn't have enough intermediation capacity, and the degree of levered positions in the markets was concerning. Finally, on the balance sheet, many participants suggested structuring future purposes as they run off the balance sheet should be done in a way that moved the maturity composition of the Fed's portfolio closer to that of the outstanding stock of Treasury debt. And various participants, that's a new adverb for the Fed, suggested it might be appropriate to consider pausing or slowing balance sheet runoff until the debt ceiling is resolved. They obviously made no decision on that and did not make any decisions on bank supervision, but it does show they were worried about more than just inflation at this last meeting.
All right, Mike, I feel like that there is definitely a follow-up to that various participants point that you made. But let me just quick check on the markets. Equity markets, S&P is up about 4 points. NASDAQ 100 is up about 6 points. So a little bit of a more positive tilt, but call it really slightly. More importantly, let's get to the U.S. Treasury trade. We had a 455 read on the 10-year. It's at 454. The 5-year, if I look at it, was at 438. That's where we find it. Shorter end of the yield curve, most sensitive to what the Fed may say or do. That's exactly at where it was prior to the Fed minutes, and that's with a yield of 428. Hey, Mike, anything in here that beyond the various participants, or that included, that would make investors, traders think differently about what the Fed might do differently from what we got at that Fed meeting?
Not necessarily on monetary policy, and many of the Fed officials who've spoken since the meeting have talked about risks from trade policy and immigration and the fact that they don't know what they can be and they can't quantify them at this point. The bank supervision stuff was interesting because there's been a lot of talk about how strong the banks are, and there's not a lot of concern about that. At the press conference, Jay Powell talked about how SVB was an outlier when that bank failed, but apparently there's more concern about that. There's also been questions about whether the Fed would change its rules on the supplementary leverage ratio, and obviously there are concerns about whether dealers have intermediation capacity. And then, of course, finally, the balance sheet stuff is really interesting. It's something that bond traders and bond analysts are going to have to follow closely, because it's possible, I suppose, at the next meeting, if we don't get progress on a debt ceiling from the administration and Congress, they might want to consider pausing the runoff of the balance sheet until that happens.
Is it rare to get something, Mike, in Fed minutes that is so not necessarily targeted, but something that specifically calls out something that could be happening in Washington that Congress has control of?
We don't see a lot of major policy changes from administration to administration that would affect the economy in the way that tariffs and immigration policy might, tax cuts as well. So it is unusual, but it is not an unusual factor of Fed thinking over the last 4 or 5 months, because they've been trying to parse out what might happen and how that might affect the economy. And we still don't have very many details about all that. I think we've got 6 different tariff announcements, but only 1 in place. The rest postponed for a few weeks until this or that happens. So they really don't have an idea of what's going to happen, but they're putting it in the upside risks category.
Hey, one last question, Mike. So if Jay Powell was holding a press conference today off of these minutes, what would you ask him?
Yeah. Well, since everybody else before me would probably ask about upside risks to inflation, I'd be interested to know more about the balance sheet and what they're really thinking there. Obviously, the Fed, when it lets them as securities roll off up to a limit of 30 billion a month, then the rest of the rolling off money goes back into the Treasury. And there's been a lot of talk about the maturity curve for the Treasury, because the Biden administration bought a lot of short-term bills, short-term bonds, and now we're looking at longer-term, perhaps losses, because interest rates are going to go higher, but the Fed is now talking about maybe we want to go that direction. So a very interesting question ahead for the bond market.
All right. Bloomberg News international economics and policy correspondent Michael McKee out there in Washington, D.C.